Good morning and welcome to today's webinar, Cryptocurrency, Gaining an Understanding and Making Informed Choices, offered by our special guest presenter, Steve Hannigan, Director of Investment Research with GGM Wealth Advisors. My name is Jeff Stauffer, Community Relations Director with Elville and Associates, and I'll be moderating today's presentation. So welcome to those that are new to our educational webinar series and also to those that are frequent attendees. As always, when you have a question for Steve, please note it in the questions panel on your screen, and we'll take time at the end of the presentation to address all your questions. As always, your questions really help the presentation and they add value. They help others learn, so please don't be shy in posing your question at any time. You also received the presentation just a little while ago from me by email to take notes on it if you wish. The presentation is also available in the section marked handouts in the panel on your screen to download at this time. Everyone will also receive a post-webinar feedback email right after the presentation, and we ask that you please take just a few minutes to fill out this very brief survey and offer us your feedback about the presentation. And we read and value every comment that you offer. So I'd also like to offer Steve a proper introduction before we get started. So Steve is the Director of Investment Research and a member of the Investment Committee at GGM Wealth Advisors, an independent SEC registered investment advisor. Leveraging GGM's team approach, Steve focuses on creating trusted partnerships with clients to deliver customized solutions which match their expectations, financial objectives, and recommended investment strategy. By aligning client portfolios' tactical asset allocation with the prevailing economic climate and their retirement plan, Steve delivers an individualized approach to all of his clients. By coordinating with Gross Mendelson's tax advisors, together GGM and Gross Mendelson provide comprehensive and integrated financial services for high net worth families and individuals. Steve is a chartered financial analyst charter holder and a member of the CFA Institute and the Baltimore CFA Society. Additionally, he is a registered investment advisor representative with Series 65 and Series 63 licenses. So welcome, Steve. We appreciate you being here today, and also thank you to Brooke Snyder with GGM for putting this presentation together with Steve and coordinating everything behind the scenes to get us where we are today. So I'll turn it over to you, Steve, and thanks again for being here.
Jeff, thank you for the introduction and thank you for having me.
My pleasure.
Today's presentation is Cryptocurrency, Gaining an Understanding and Making Informed Choices. Just a little bit about GGM. We're an independent fee-only RIA based in Baltimore, Maryland. We also have an office in Fairfax, and we're a subsidiary of Gross Mendelson Associates. Gross Mendelson's main business is accounting, both tax and audit, and we also have an IT business. And our legal housekeeping here, none of this is specific investment advice. We're going to talk about general information and some frameworks and strategies for investing, but please don't go trade Bitcoin during this presentation based on it. So a couple goals for today. The first goal is to gain a basic understanding of the two most popular cryptocurrencies, and then develop a framework for potentially investing in crypto. So part one, gaining an understanding. Here we'll go over some crypto basics. There are hundreds of cryptocurrencies out there that you can invest in, but we're going to mainly focus on Bitcoin and Ethereum. We'll use these as a frame of reference, and if you have an understanding of these two, then you have a good base for researching any other cryptocurrencies you want to talk about or research. All right, so the crypto craze. Why is everybody talking about crypto? Why is everybody here taking some time out of their day to listen to me talk about crypto? Well, it starts in 2008. Coming out of the financial crisis and the bank bailouts, a white paper was published by somebody calling himself Satoshi, proposing Bitcoin as a peer-to-peer payment system. Then we fast forward to 2020, when it really broke into the mainstream. We were in COVID lockdown, there was zero interest rate policy, stimulus payments were going out, there was a ton of liquidity in the system. And some of that liquidity found its way to crypto. Bitcoin was all of a sudden everywhere. Some people were interested in it because It has the potential to be a new currency. Some people like it because it's decentralized and independent. In the 2020 environment, you had global central banks pushing out stimulus, printing money, devaluing currencies. So some people were looking for something that was outside of that system. It could also be a store of value. Again, in that environment, what's outside of the global monetary system as we know it. Other people were attracted to the technology. Blockchain, the underlying technology, has a lot of potential uses for the future. And then the last thing was to potentially get rich. The idea of making a lot of money quickly with very little work is very appealing to a lot of people. I say that half joking because we know it's not that easy, but there are behavioral finance issues at play here. The desire to get rich quickly and the fear of missing out when you think other people are getting rich quickly are definitely something we have to be cognizant of. If we're not, it can lead to bad investment decisions. But it's certainly not easy to ignore some of these things, especially when you see crypto and potentially how much money people are making all over Twitter. You see Tom Brady and Matt Damon pitching it on TV. It was everywhere for a while there. So we're going to start with Bitcoin. And a basic background here. Bitcoin is a decentralized digital currency that you can buy, sell, and exchange directly without an intermediary, such as a bank. It's an electronic payment system based on cryptographic proofs. It's an alternative to fiat currencies like the US dollar or the euro. Supply is intentionally limited. There will only ever be 21 million Bitcoin out there. And its value is not backed by anything physical. It's only backed by supply and demand characteristics. And that makes traditional investment analysis difficult. But we'll get into some ways we can use valuation methods later, but you can't look at it in terms of popular metrics like you would look at a stock. There's no PE ratio. You can't look at it like you would look at Apple. What's their iPhone forecast? What are their suppliers' forecasts? So that makes investing difficult. So how does Bitcoin work? The basic principle of Bitcoin is based on a running ledger of transactions. We're all familiar with this concept. If you've ever taken a group vacation with your friends or extended family, you rarely pay for everything you do as you do it. Somebody gets this round of drinks at the bar, somebody pays for this round of golf, and at the end of the vacation, you settle up, whatever the differences are. Well, Bitcoin takes this one step further. It proposes that what if you never settle up? What if you just keep a running ledger? So if you were to propose this to me, the first thing I would say is, well, we need a very trustworthy, accurate, and secure record keeper to keep track of the ledger. And that's essentially what Bitcoin wants to be, and specifically what blockchain was built to be. So we'll start a running example here. Say Steve wants to send Jeff 1 Bitcoin. Steve writes in the ledger, Steve pays Jeff 1 Bitcoin. We talked about the need for it to be secure. So for a digital currency to be secure, users have to have confidence that only legitimate transactions appear in the ledger. To ensure this, digital signatures are used. The defining component to digital signatures is cryptology. That's why these digital currencies are called cryptocurrencies. And that's made up of 3 elements: a private key, a public key, and a transaction-specific message. So each user has a public key and a private key for their accounts, and a digital signature that's put on each transaction entered into the ledger is made up of a transaction-specific message and the private key. So back to our example, Steve has his ledger entry and he signs it with a message specific to this entry and Steve's private key. And what this does is it solves the double spend problem. It also prevents fraud. Say that there's another person out there, we'll call him Mike. Mike can't go and say, I would also like 1 Bitcoin from Steve, right? Steve pays Mike 1 Bitcoin in the ledger and copy and paste that electronic signature, because the message, half of it is specific to the Steve pays Jeff entry. So that would get thrown out and that would get rejected. We'll go to the technology. So blockchain, I'm sure you've heard a lot about that. It's the underlying technology that's used to keep the ledger for Bitcoin transactions. Each new Bitcoin transaction is added to a block of records, which are then verified and secured across a decentralized network of computers. These blocks have limited storage, so when each block is filled, it's chained onto previous blocks, forming a string of data. And any attempt to alter, delete, or change a piece of data on the blockchain will be identified by the other computers that are validating it, thrown out, and replaced with the correct blockchain data. So where does Bitcoin come from? There's two ways to acquire Bitcoin, mining and purchasing it. We'll talk about mining because that's key to how it works. So Bitcoin miners receive Bitcoin as a reward for completing blocks of verified transactions, which are then added to the blockchain. It takes 2 steps to create a verified block. A miner must verify 1 megabyte worth of transactions and then be the first miner to arrive at an acceptable answer to a numeric problem. This is known as proof of work. So the formula they have to solve includes a cryptographic hash, and it's a 3 variable equation, the hash, an input, and the output. And the properties of the hash mean that you can't solve backwards. So essentially what has to occur here is guess and check on a massive scale. The possible inputs are 2 to the power of 256, which is a 78-digit number. So you are looking for a couple correct answers out of a 78-digit number of possibilities. So there's no way you can sit there and do that on your own. The only way to solve this quickly, because it is a race, is to use massive computing power. It's estimated that the cost in electricity to solve the problem is 5 figures. And global Bitcoin mining, because of these massive computing farms that are used to do it, uses as much energy as the country of Argentina. So back to our example, Steve has signed his entry. Steve pays Jeff 1 Bitcoin is entered. That's classified as an unverified transaction. Bitcoin miners then verify the transaction and group it with other verified transactions. That goes into a block. They race to complete the hash function problem. The first one to do so gets to create that block. They get their Bitcoin reward. More Bitcoin has been mined, and the transaction's verified. Once the transaction's verified, it becomes a block on the blockchain. Each block takes about 10 minutes, give or take, to create. And as that block moves further down the chain, as more blocks are added onto it, it gets more and more secure. It gets harder to alter. So transactions like this are deemed to be settled or fully complete about an hour after they're completed. So about 6 blocks down the blockchain. So we'll get to Bitcoin and the US dollar. The other way to acquire Bitcoin is to purchase it. Most investors don't have a server farm or computer farm they have access to, so they're going to purchase Bitcoin if they'd like exposure to it. Exchanging dollars for Bitcoin is similar to exchanging dollars for euros. We talked about there's a finite amount of Bitcoin available. So the laws of supply and demand tell us as long as demand continues to increase, but supply is controlled, price should continue to appreciate. Who controls Bitcoin? Bitcoin is independent of any centralized monetary authorities. Talked about that as being a major attraction for some people who would like a store of value or currency that's outside of the global monetary system. It can't be affected by the world central banks. Nobody can just go out there and print more Bitcoin to devalue what you have. But the lack of a controlling authority means that you're pretty much on your own when it comes to Bitcoin. If you lose your account, if you lose your password, that Bitcoin can be lost forever. There's a story of somebody in Germany who was an early adopter of Bitcoin. They can't remember their password. Behind that password is several million dollars worth of Bitcoin, and they're on their last try. So because it's independent, there's really no help desk. And is it regulated or legal? It's legal to buy, sell, own, and transact Bitcoin and other cryptocurrencies in the US. It's not regulated by governments or central authorities, but some of the exchanges are. So it's not completely anonymous. If you open up an account on an exchange, they do have to follow procedures similar to opening a brokerage account at Charles Schwab. And then there are some countries that have outlawed Bitcoin or restricted it. These generally tend to be countries that have capital controls or try to control who can take money out of the country, because this was a way to sidestep some of those regulations. So what are the pros of Bitcoin? Improved accuracy in transactions by removing human involvement and verification. Eliminating third parties can lead to a reduction in costs. Decentralization makes it harder to tamper with, as governments can't act to change the value. Transactions are ideally private, secure, and efficient. It's a transparent technology that doesn't have a single owner. And as fiat currencies are potentially devalued, it can offer a store. And then what are some of the cons? There are significant technology costs, which come in that computer processing power that are needed to mine Bitcoin. And it is possible for Bitcoin to be used for illicit activities. Anytime you have something that's somewhat outside the control of the government, that can lead to some unsavory characters using it. There's also the potential for the governments to attempt regulation. Some governments have outlawed it. Government doesn't generally like competition, so that's something you have to keep an eye on. And then the power needed to mine Bitcoin can be an environmental issue if it's drawn from dirty sources. So that's Bitcoin. The other cryptocurrency we're going to talk about today is Ethereum. This is the second most popular cryptocurrency. And Ethereum is a network composed of thousands of computers all over the world. It's not a currency, it's actually a platform. Ether is the cryptocurrency that's used to power the Ethereum network. So when you hear people talk about Ethereum, the price of Ethereum, how that's moving, they're actually talking about Ether. And Ether is used to incentivize people to run the Ethereum program on their computers and lend their computing power to the network. Code writers also must pay in Ether to have their applications run on the Ethereum network. And applications can be written on the Ethereum network to do almost anything. Process financial transactions, store data, execute smart contracts. And here we'll talk a little bit about the differences between Bitcoin and Ethereum. So Bitcoin is what's known as a first generation blockchain, the technology behind it. It was written in the Turing incomplete language, coding language, and that means that there's limited applications that the code can be programmed to solve for. Essentially, it was built to be able to sustain the functions needed by Bitcoin for its use as a currency, but nothing else. So once Bitcoin came out, people said, okay, this is a stab at decentralizing banking and currency. What else can we decentralize? So Ethereum uses what's known as a second generation blockchain. It's written in the Turing complete language. And that means that given the necessary instructions, enough time, and sufficient computing capacity, it's capable of solving any computational problem. So Ethereum is essentially an open source DIY platform for decentralized applications. It's built as an operating system that any coder who learns its operating language or Solidity can go in, code a program for a perceived need, and hopefully earn Ether by executing that program. So one of the main examples of the possibilities of the Ethereum network is the smart contract example. Right, a smart contract can be defined as an application program that runs on the blockchain. Its parameters are written in code, and it's executed on Ethereum. The goal is to remove the middleman, allow the parties of that contract to deal directly with each other. The contract acts as judge. It's executing if-then statements laid out in the contract. And a popular example is a rental agreement. So a renter and a property owner can use a smart contract to lay out terms of the lease of an apartment, say, and ensure all parties abide by the terms. The only parties necessary are the property owner and the tenant. If at the end of each month the correct payment is made, the program can verify that. There's an electronic lock on the door, say, so the renter's key card works. If the payment isn't in the account, the contract realizes that, and the renter's key card does not work. He's locked out of the apartment. So you can remove pretty much everything except these two participants in the deal. One downside is that a smart contract is uncompromising and letter strict. It's an if-then statement. If the money's there, the person gets to use the apartment. If not, they don't. We all know that that's not how real life works. Real life happens. There's mitigating circumstances that come up. It also doesn't take into account any kind of the spirit of the contract. If somebody finds a loophole that's not addressed in how the contract was written, it will let them use that loophole to their advantage. Okay, now that we've gotten a basic understanding of two of the most popular cryptocurrencies, we'll start talking a little bit about the mechanics of how to potentially invest in them. So there's two main options for investing in Bitcoin. You can invest in directly, or you can use Bitcoin ETFs. So direct investment is opening an account at a brokerage or payment processor or a cryptocurrency exchange. An example of a brokerage or payment processor is PayPal or Robinhood. They both allow limited crypto trades. And then an exchange would be something like Binance or Coinbase. Before you decide where you want to open an account, you need to have a plan to know what you want to buy. Do you just want to buy a little bit of Bitcoin, or are you looking at one of the more obscure cryptocurrencies out there? Do you want to trade cryptocurrency for cryptocurrency? And then something that's needed if you're going to take this route is a cryptocurrency wallet. This is what holds that private key from our example. So that's what keeps it secure. You never, under any circumstance, want anybody else to get your private key. There's two main types of wallets: a hot wallet, which is web-based, it's online. It's a little bit easier to keep track of because you have a login, but hacking is a potential. And then a cold wallet is an offline wallet. That's a physical device that requires possession. It obviously can't be hacked, but you can't lose it either. So there's pros and cons for both of these. As with most things in investments, little advice is diversify. We saw what happened with FTX. You may lose your cold wallet. I would use multiple of these means. The other option that has come to market more recently is a Bitcoin ETF. The name's a little misleading. Right? Does a Bitcoin ETF actually own Bitcoin? It's a simple question, but a more complex answer. In short, the answer is not really. There are spot price Bitcoin ETFs that would actually own Bitcoin that providers have applied for, but none have been approved. So the only Bitcoin ETFs we currently have use Bitcoin futures contracts. A futures contract is an agreement to buy or sell a specific asset, in this case Bitcoin, at a predetermined time and price. So what the creators of these ETFs are using are futures contracts to speculate on the direction of Bitcoin's price movements. So neither the ETF issuer or the investor own the underlying asset, which is Bitcoin, but it will give you exposure if you're just looking to make some money when Bitcoin goes up. This is an easier way to do that because these ETFs can be purchased in any investment account, any brokerage account, and it eliminates the need to open a new account and go find a virtual wallet. So some pros and cons for the Bitcoin ETF. Pros, it's easy, accessible way to add Bitcoin exposure. You can also hold these in IRAs or tax advantage retirement accounts. This gets you out of potential capital gains taxes. This has allowed Bitcoin to become a little bit more mainstream. As I said, for those who want to participate in the price movement, but don't want to go through all the steps of opening a dedicated crypto account. There are some drawbacks. It has a higher cost. You have to pay for the cost of these futures contracts, as well as paying the manager their cut. So there is an expense ratio that's significantly higher than anything you would find with a digital wallet. There's also tracking error, which is defined as the difference between Bitcoin's price movement and how the ETF tracks it. If Bitcoin's up 10% in a year and the ETF is up 6%, that 4% gap is the tracking error. That has to do with the cost and how futures contracts work mechanically. And it also does not own any Bitcoin. If you're buying Bitcoin because you want to potentially use it someday, you don't have claim on any Bitcoin. So that was the background on Bitcoin and Ethereum. Hopefully you learned a little something there. And going forward, we'll use what we learned to discuss investing in crypto with the goal of creating a framework for decision making. And we're going to use Bitcoin as the potential investment here, but this process can be used for most cryptocurrencies. So we'll start off with, what is crypto or Bitcoin to you? And this tweet is a popular tweet, probably seen it, that is used to show one of the first relationships here of, is Bitcoin really a currency? Can you use it as a currency? It comes from 10 years ago. It's prizes for a tournament. The first place got $500. 5th to 8th place got 25 Bitcoins. You put that in today's dollars, that's $600,000. Would have really paid to be 5th through 8th. And the point that this shows is, while significant volatility in cryptocurrency allows investors to make money by holding it, it's also restricted its adoption as an actual usable currency. So for example, nobody wants to use Bitcoin to buy a $50,000 car, and 2 weeks later you find out, well, the Bitcoin I used to buy that car is actually worth $75,000. And on the other side, the car dealership doesn't want to accept Bitcoin that could significantly depreciate very quickly for their asset. So are you going to be using cryptocurrency as a currency? Probably not. Are you going to use it as a store of value? It could have those properties over the long term, but it's certainly very volatile, and it's not something that's going to add stability to your portfolio. Are you going to use the technology? You could go learn Solidity and start coding Ethereum, after this presentation, but probably not. Is it an investment? Yes, that's probably what we're going to use it as. We want price appreciation here. We're looking to make money on the investment. We want to buy low and sell high, or at least sell higher than we bought. So some investment theory before we get started. The first thing that's crucial is having a plan. You want to outline your goals and objectives. How much risk do you want to take? What strategy are you going to use? And having this plan helps us overcome some of those behavioral finance issues that we talked about earlier in the presentation. The last thing we want to do is chase Bitcoin's price. You see a tweet that Bitcoin's been going through the roof. It's up to $40,000 per Bitcoin. Okay, I'm going to go buy some. Pay attention for a while. A month later, your buddy tells you, hey, Bitcoin's tanking. It's down to $20,000. Okay, you go sell it. That's not what we want to do. We want to have a plan that can stop us from acting on those emotions and making questionable investment decisions. You need to do your research. We talked about Bitcoin and Ethereum. If there's anything else you want to invest in, do some background, know what powers it, what's the technology behind it. Do you believe that that technology has promise, it could be adopted in the future? And then choose a strategy, buy and hold. That's the easiest one. Take a chunk of money, you buy a cryptocurrency you want. Say, I'm not going to worry about the volatility. I'm going to hold it for 5 or 10 years. I think it'll be adopted. In 10 years, it should hopefully be higher. You could also dollar cost average. That's buying a little bit each week, month, quarter, year. Some of the exchanges have an option that allow you to automate that. So that's very helpful. And then there's active management, which is shorter term, trying to buy and sell get in, get out, and make money. This is a little bit harder, but we'll go over some strategies that you're probably already familiar with that can help with that. And then as big picture, what we talk to clients about is if you're interested in this, if you believe in the technology, if you want to invest in it, fine, but don't jeopardize your financial plan. This should be something that if it works out, great, you've improved your financial situation. Maybe that's how you buy that vacation home you've always wanted. If it doesn't work out, you want to know that you're still okay, you're still going to be able to retire on time. So if you've done your research, you've come up with your plan, you've decided, hey, I want to buy a little bit of cryptocurrency, a little bit of Bitcoin. The next question is going to be, what's the source of the funds? Where's the money coming from? As a financial advisor, if I could answer every question I get with one answer, it would be save more money. So if you have excess cash flow that's not in your retirement plan, that's where I would go first. That lends itself very well to the dollar cost averaging. You've got a little excess cash flow, buy a little bit over extended time periods. If you're going to use existing investments, you're going to take a part of your brokerage account, a part of your savings, and use that to buy cryptocurrency. We want to make sure that we consult our financial plan and that we plan for zero. So I'm going to assume most of you work with a financial advisor. If you do, you probably got something like this. This is a financial plan that we do for all our clients. At the end, after you put in all the financial information, assets, spending, goals, a Monte Carlo simulation is run. It's a computer model that runs hundreds of possible outcomes and gives you a probability of success. In this case, success is defined as not running out of money. There's a lot of different programs for this. The one we use, if you're above 75% probability of success, that's a successful plan. And you can see the plan lines on the right there. You have the median, you have the darker blue line, which is the most likely outcomes, and then you have the lighter blue lines, which as it puts different variables for returns and that kind of thing. You know, if you get all historically high returns, it's going to look really good. All historically low returns over that many years, it doesn't, but we're looking at that median line. So the first thing I would do is I would talk to your planner and say, hey, I want to invest X amount of money in cryptocurrency, and just take that out of the plan. Pretend it doesn't exist. If you have an 81% probability of success, if you take that chunk of money out and it drops to 80, fine. You know, you're good to go on that. If you take that chunk of money out and it drops to a 50% probability of success, that's something that you're really going to want to look at and probably alter your plan a little bit. And then I say plan for zero, because zero does happen in cryptocurrency. This is a price chart of the Terra USD, which is UST, which is a stable coin of the Terra network that's linked to Luna, which was allowed to freely fluctuate, like most cryptocurrencies such as Bitcoin. Terra, or UST, was designed to have a value of 1 UST equals $1 to make it easy to use. In 2021 and 2022, this blockchain and cryptocurrency was getting a lot of publicity. If you're a baseball fan, the Washington Nationals even entered into a deal to work towards accepting UST at their stadium. Unfortunately, the algorithm failed. We talked about supply and demand dynamics. Demand went away. There were no buyers. The algorithm that was supposed to hold the peg failed, and both ended up going to zero. And this was a pretty significant cryptocurrency. In this crash, it's estimated that $40 billion were lost. So that's why we want to make sure we plan for zero. Cryptocurrency has a lot of potential upside, but we don't want to be so invested in it that you're putting your financial future at risk. So when we started evaluating Bitcoin, because clients started talking about it, it was all over the news. The first question we had as we framed how are we going to give advice on this, other than just understanding what it is what type of investment asset does it trade like? What's it correlated to? So some people think Bitcoin is virtual gold. So we started with gold. You have the white line there is Bitcoin, the blue line is gold. That didn't really match up, not a high correlation. Then we went to currency. The white line again is Bitcoin. The blue line is the US dollar. Again, not a great match. We went to risk assets, equities. This is the S&P 500. The scale throws it off a little bit, but if you look at the correlation numbers, you're getting a little closer. And as we looked, the closest thing we could find was actually the Goldman Sachs non-profitable tech index, and that matches up pretty well. So the non-profitable tech index is tech companies that don't currently make money, but that have an idea that people like and people are buying the stock. It tends to be very volatile, as you can see, but it actually matches up with that pretty well. So crypto, specifically Bitcoin, is a risk asset, or acts like a risk asset in terms of an investment. Why is this important? It allows us to gauge portfolio risk and adjust your asset allocation, and it provides us an opportunity for active management. So this is another piece of software we use to help our clients. It's called Riskalyze. It helps us analyze portfolio risk at the individual security and then the portfolio level. So here, the 60-40 portfolio is your standard textbook portfolio made up of 60% equities, SPY, and 40% bonds, aggregate bond index. So because we know the cryptocurrency trades like a risk asset, that helps us gauge the source of the money and the portfolio risk. The second one over, the risk number 58, is if you wanted to invest 5% of your portfolio in cryptocurrency or Bitcoin, and you take that 5% from the fixed income bucket, so you now have a 60-35-5 portfolio, you've bumped up your risk fairly significantly. So what you thought was a 60-40 is now playing more like a 70-30 portfolio. Whereas if you take that 5% crypto allocation from the equity bucket, which we know it trades more like, it acts more like that, you've mitigated some of that increase in risk. Crypto, still more risky than the S&P 500 as a whole, but you haven't upped the risk of your portfolio as much. The key here is we don't want surprises. You don't want to look at your portfolio and say, hey, I thought I had a moderate risk portfolio. Why am I down so much in a bear market? So now we'll talk a little bit about how we manage more conventional assets and how we can use that for crypto. We subscribe to an economic theory that's based on the rate of change of economic growth, which is GDP, and inflation, which is CPI. And based on that rate of change, we can create a diagram that has 4 different environments that the economy is in. The analogy we use are the 4 seasons. And what we try to do is adjust or dress our clients' portfolios for the proper economic environment or for the proper season. You know, if you are in shorts and a t-shirt in the blizzard, you're not going to be comfortable. Same thing if you're in a parka at the beach. If your portfolio is not properly adjusted for the prevailing economic environment, you're either going to miss out on gains or experience increased losses. So this is a chart that we use. What we really want to focus on here is the x-axis. That variable is economic growth. So what we've done is we've back tested over the last 20 years and figured out which sectors and which investments do best in each environment. And what we have here is the best sector in each environment. And it's pretty intuitive. When you have growth increasing, you're above that line, the economy is going well, you're going to get more investment in things like discretionary purchases, technology companies. That makes sense. When things aren't going quite as well, people are tightening their belts a little bit. They still have to pay their rent. They still have to pay their utility bill. More defensive sectors outperform. The best sector or the best season for the S&P 500 as a whole is summer. That's also when non-profitable tech and crypto do the best. The worst season is winter. Not every winter season has a bear market, but most bear markets happen in the winter season. That's when non-profitable tech and crypto does the worst. And when we're talking about client portfolios, one of the real ways you can lock in outperformance over time is to avoid those bear markets. It's math. If you can sidestep the large sell-offs, you really set yourself up well. If you have a $400,000 portfolio, you're down 50% in it to 200,000, you're actually needing 100% gain on that remaining portfolio just to break even again. And then this is our outlook. As you can see, 2022 is a very tough year for crypto and equity markets. The entire year was spent below that line, the rate of change of economic growth slowing. The first quarter of this year, we projected to be above the line. So far, we've seen that type of price action. Crypto's done well, tech stocks have done well. We project one more quarter in summer, and then we're going to be back below the line in winter. But this is a framework you can use if you're talking to your financial advisor. They probably don't have an outlook on crypto or Bitcoin, but they definitely should have an outlook on the US economy, on GDP, on the tech sector. So if you know that crypto trades a lot like high-risk tech stocks, that can give you a frame of reference for when you should buy them and when you shouldn't. And then one last thing here, as I mentioned, we're a subsidiary of a CPA firm, so we have to talk about taxes a little bit. If you hold crypto in a taxable account, it is a taxable asset. Buying and selling will generate capital gains. There were some horror stories of people who made some money in 2020 and didn't realize this, spent all the money, then had a very large tax bill they had to come up with. On the flip side, realized losses can also be valuable. If you have lost some money in crypto, you can use those losses to offset gains in other investments. So that is the end of the presentation. And now we will go to questions.
Well, thanks, Steve, very much. So everybody, now would be your time to get those questions into Steve. Don't have any questions as of yet, but I know that there are questions out there. I'm sure of it. So bring those questions in. I'll say a couple things while you do send those questions in to Steve. We've got some time. Let me ask you, Steve, I think you might be surprised, or maybe not, that at the number of people that actually don't have a financial advisor or certified financial planner of that nature. Can you talk for just a minute about the benefits of working with somebody like you to address their financial needs for now and in the future?
Sure. So what we do with most of our clients is we meet with them and we create a financial plan. And this is their overarching roadmap. This helps them aggregate all their assets, know where all their assets are, create an investment strategy that's consistent throughout it, and tailor their risk profile. So if you have the financial plan as the roadmap, the next step down is creating an asset allocation. So we want an asset allocation, a mix of stocks and bonds that is something that allows them to achieve their financial goals, but also isn't so much risk that they can't sleep at night. Right? We want to create a portfolio that they can ride through market ups and downs with and they're confident. Because the last thing we want is somebody to say, hey, I'm definitely comfortable taking a ton of risk. You get a year like last year, I can't do this, and you sell at the bottom. That's how you can destroy some wealth. So by having a long-term plan, we can avoid some of those pitfalls. And then the last thing we do is actually the individual security selection. There, we're using our expertise to hopefully avoid some of those pitfalls, avoid bear markets, like we said, and help them be on the upper side of that Monte Carlo simulation.
Okay, very good. Thank you. Yeah, very helpful. Here at Elville & Associates, we really believe strongly in all of our clients having a financial advisor. to make sure that their needs are being taken care of. So yeah, very, very important. Please reach out to Steve with any questions that you might have, regarding any financial questions or planning that you might have. So it looks like we do have a couple questions that I forwarded over to you, Steve, to get us started here. And if you see those and want to address them, that'd be great.
Okay. And just on questions in general, I know it can be hard to talk about this in a public setting. If you have any more personal questions, feel free to shoot me an email. So we have a question here. What trading platforms have you found better than others for dealing with crypto? And that question is really based on what are you looking for? If you're just looking to buy some Bitcoin and hold it, things like PayPal work very well. A lot of people already have a PayPal account. It's simple, it's streamlined. If you're looking to buy any number of currencies, if you're looking to trade them, if you want to hold them outside of an exchange, something like a Binance works well. But as I said during the presentation, it's a good idea to diversify in general when it comes to investments, but diversify where you hold any cryptocurrency you have as well. So it's really, there's a lot of options out there. You can tailor what you use to your goals. And that's something on a personal basis that we can help with.
Very good.
Another question, is there legislation or emerging legislation designed to control crypto? I would say yes, that's something that governments all over the world are looking at and that you have to keep tabs on. Certainly the collapse of FTX has brought that to the forefront in the United States. And then other countries have looked at banning crypto or have looked at regulating mining because of the environmental impact, the energy impact. So it's definitely something that's been picking up and will continue to pick up into the future.
Okay. Now, I think we have one other question. Are there any crypto platforms that should be avoided? I think you pretty much addressed that with your initial answer to the first question.
Yeah.
And then looks like we have another one. Let's see here.
Do you see another one?
Yeah, just sent it your way here.
Okay, so is the taxation normal short-term, long-term capital gains? Yes, it is. And that's something that when you're looking for a provider or service to use that you should take into account. Some are much better at others and at tracking your purchases, your sales, your potential tax bill than others. So especially if you're looking to trade, be a little more active, you want a service that will give you that report. So you're not stuck at the end of the year trying to calculate, hey, what were my gains? What do I owe taxes on?
Okay. And let's see if we have anything else here. Looks like that's everything for right now. We have any other ones? We'll get to those while we wait for any final ones. I'll say as far as our webinar series here goes, we continue on. Tomorrow we have our senior principal here at the firm, Lindsay Moss, our elder law attorney as well, talking about Medicaid long-term care asset protection planning. That's at 10:30. And then on March 1st, next Wednesday, our managing principal, Stephen Elville, is going to be talking about understanding estate and trust administration. And that's something we try to offer on a quarterly basis. And we'll be bringing that back again at 10 o'clock next Wednesday, the 1st. And on March 3rd, we'll be partnering with our friends, Bill Huffnell at Bay Point Wealth, to talk about 10 mistakes to avoid when planning for a loved one with special needs. And that is at 10 o'clock on March 3rd. So looking forward to that new presentation that we'll be offering as part of our webinar series here. and see if we have any final questions here for Steve. Looks like that's it. So Steve, thank you so much for your time, for bringing some clarity to an interesting topic that I think a lot of people don't necessarily understand on the surface. So we appreciate you being here. Steve, please use Steve as a resource for any questions that you might have, and look forward to having you back again sometime in the future.
Thank you for having me.
Okay, thanks everybody, and we'll see you again soon as part of the Elvo webinar series. Have a great day.